Welcome into Clear Picture Financial. Your host is Jason Noble, and you can find Jason at Prime Capital Investment Advisors. He's a fiduciary advisor, holds his FINRA Series 66 securities registration. He's a certified financial planner and retirement income certified professional with 18 years in the financial arena, helping his clients get ready for retirement. I'm Morgan Patrick, consumer advocate. Each and every week, we talk retirement here on the program, and each and every week, we give you an opportunity to get on the calendar with Jason Noble. No cost, no obligation, no pressure. See where you are in your retirement planning process. And folks, this is an opportunity to kind of gauge where you are. If you haven't started planning, jump on one of those appointments. Or if you're in the middle of something and you need a second opinion, one of those appointments could be for you as well. But we'll get into that as we get through this portion of the program. Tax-deferred retirement accounts, Jason, are great until they're not. So we wanted to outline the issues and offer up some potential solutions to avoid, as you mentioned, that tax time bomb. So snowballing required minimum distributions. Talk about that a little bit.
Yeah, tax-deferred savings have been associated with tax liability that you have to pay someday. The IRS will only let you avoid taxes for so long. Withdrawals from tax-deferred accounts are taxed as ordinary income. Now, you may begin to take withdrawals without penalty from tax-deferred accounts starting at age 59 and a half. But many investors wait to make withdrawals until they're required to take the required minimum distribution, or also known as RMDs, and that's at age 72 now. Your tax liability continues to grow over time through contributions, employer matches, and your investment returns. Eventually, this growing tax liability can snowball. But most investors have no idea of the damage it could cause in retirement. For instance, I have a couple I work with that lives in Almondale. They continued saving until retirement, and then they reached out to me. They faced 4 tax time bombs within their strategy. First is when they took Medicare, which is what I'll address later in the conversation, okay, Morgan? But second was when they turned 72 years old, having to take required minimum distributions that caused them to take out more than what they actually needed to withdraw. The third tax time bomb was when one of them passed away, leaving the remaining spouse to take required minimum distributions at a single filing bracket, thus at a higher tax bracket. And then fourth was when they both passed away, their beneficiaries had 10 years to take 100% of the account balance out to avoid a 50% excess tax. Serious conversations that need to be happening now to avoid these tax time bombs in the future.
I tell you, I mean, just think about that, folks. I mean, there are a lot of hurdles involved here. You need to plan for them. You're listening to Clear Picture Financial. Your host is Jason Noble. Again, you can find him at Prime Capital Investment Advisors. Going to be an opportunity to get on the calendar with Jason if you've got situations, maybe you have several tax time bombs lurking, and you need to be aware of that. Have that conversation, and you can do it at no cost, no obligation, no pressure. So tax-deferred retirement accounts. I mean, they're great until they're not, and we're trying to, give you some solutions to some of these tax time bombs. So snowballing required minimum distributions we've talked about. What about this one? Medicare means testing.
Yeah, the story doesn't end there, as I alluded to, as it gets worse. High RMDs are likely to trigger Medicare means testing surcharges. Avoidable taxes by a different name, right? During retirement in the form of higher premiums on Medicare Part B, which is like doctor's visits, okay? And Part D, which is prescription drugs. The couple in our example above is projected to pay $1.5 million in Medicare means testing surcharges through age 90.
I tell you, think about those numbers, folks. I mean, these have to be planned for. And a lot of people, it's kind of on the back burner, and they can be surprising, and they can absolutely put a crush on your retirement. So let's talk about another one. You mentioned this in your example, Jason, but tax burden for heirs. I mean, if it's there, it's going to be handed down.
Yeah, and at death, assets remaining in inherited tax-deferred accounts have never been taxed. So the tax liability is passed along to the heirs. In the 2019 Secure Act eliminated that stretch IRA, which allowed heirs to stretch out the RMDs from inherited IRAs over the projected life expectancy. Now, under the new law, RMDs and inherited IRAs are no longer exist, but the entire account must be depleted within 10 years. And every withdrawal is taxed as ordinary income at the heir's marginal tax rate. So if they're making income, that money that's withdrawn with those 10 years is added to that, just increasing their overall tax liability.
I'll tell you, a lot
Very
of
important conversation,
yeah,
Morgan.
I was going to say a lot of questions need to be answered. Going to be an opportunity to get on the counter with Jason Noble. Again, you can find him at Prime Capital Investment Advisors right here in the Charleston market, host of Clear Picture Financial. So, there are issues there. The tax time bombs you got to avoid. We talked about snowballing required minimum distributions, Medicare means testing, tax burden for your heirs. We've hit on that several times. So now, what can you do? Maybe shift savings from pre-tax to Roth accounts.
That's correct. You lose the tax deduction in the current year, but your tax-free savings will snowball in the future in a good way. This is also the easiest strategy to implement of all of them. Okay, many of my clients aren't aware that they have a Roth option within their 401k or even 403b, or mistakenly think they cannot contribute to one because of their income limits. But that's not true. So find out if your plan offers a Roth option. Otherwise, you could consider a Roth conversion approach, which I'll touch on later if we have the time. Speaking with a qualified advisor or tax professional suggested before attempting any of these considerations.
Tell you, folks, having a plan. We talk retirement each and every week here on Clear Picture Financial, powered by Prime Capital Investment Advisors, where you can find Jason Noble. But having that ease of mind, knowing that you've at least started the process of creating that roadmap to retirement. And we talk about puzzle pieces and making sure you have the right puzzle pieces and they all fit together snugly for your retirement. That takes a plan. There's going to be an opportunity to get on the counter with Jason Noble here in just a little bit, so take advantage when we open up those spots. But right now, just outlining the issues and with these tax time bombs, and also, offer up some solutions. So let's go to this next one, Jason. Take advantage of asset location.
I love this topic. With this strategy, investors place their assets in different types of tax buckets. You have the taxable bucket, you have the pre-tax bucket, and then a tax-free bucket. As an example, asset location typically places investments with low expected returns, such as bonds, into the tax-deferred accounts, and investments with high expected returns, such as small value or emerging market stocks, into a tax-free Roth account. The net effect is that your tax-deferred account will grow more slowly, and so will your future tax liability, while your tax-free accounts will grow the most. Now, few investors have ever heard of asset location, and it could be hard to implement, but it can significantly reduce your taxes in retirement and increase your after-tax wealth. For instance, I have a couple I work with right now that they have their money in 3 different buckets. Now, I'm able to withdraw enough money from the pre-tax account to take advantage of the standard deduction. So that money's coming out without any taxes, taking the rest of their income that they need from their Roth account and their taxable account. They're receiving over $80,000 of income, but because of asset location and working with me and their accountant, we're able to make the withdrawals where they're paying no federal income taxes, which is absolutely incredible at that bracket. $80,000, no taxes. That's amazing. And I'm proud to share that story with you today, Morgan.
Jason Noble, you can find him at Prime Capital Investment Advisors in the Charleston market. And again, folks, it's always about retirement here on Clear Picture Financial. Check out the website, clearpicturefinancial.com. It's a great resource for you. You can kick the tires there. You can find out more about Jason Noble and his team. Again, Jason, with 18 years in the financial arena, helping hundreds of clients get ready for their retirement. Again, outlining the issues and offering up potential solutions to those tax time bombs that are out there. And believe you me, they're out there. Last one we have time for, Jason, you should consider, and you've talked about this a little bit, but the Roth conversion.
Yeah, a Roth conversion involves transferring money from an existing tax-deferred account to a tax-free Roth account. The transfer amount will usually is fully taxable and as ordinary income in that year. So this is a good strategy to consider in low-income years, especially for people who retire early in their 50s or even early 60s, who may have several years to do conversions before Medicare means testing surcharges. So Security income and RMDs kick in. Many of my clients do annual Roth conversions early in retirement. And we just call that strategy is called a bump up Roth conversion. You bump up into the bracket where you don't exceed the bracket. This has to be addressed working with a qualified professional and an accountant. So important that it's being looked at in many different considerations.
I tell you, there are a lot of questions popping up. Listeners, viewers, you are thinking, okay, maybe I'm not ready for retirement. I thought I have this great portfolio. but I don't have a plan. So now's the opportunity to get on the calendar with Jason Noble at Prime Capital Investment Advisors. Jason, you've got limited spots. I believe we have 5. We're going to open those up right now. What's going to happen for these 5 callers?
Yeah, if you're one of the next 5 callers, we're going to custom design a clear picture analysis financial review that will indicate if you're in need of a full-blown wealth plan. We will refresh your financial plan, especially with all the changes we're seeing in today's economy. We'll do a risk-first approach to help protect your money and optimize your portfolio. We'll provide tax optimization, see if there's ways that we could get more money in your pocket and evaluate your estate plan. This is complimentary for the next 5 callers, Morgan. Please let them know how they could reach out to us, see if we can help.
Absolutely. Here we go. And again, we want to remind you, we've been talking about tax time bombs. That's just one portion of retirement planning. Make sure you have a plan. You can have this conversation about, hey, how can I, manage these taxes? Because we're going to have to pay them. Just make sure you have a plan for it. All right. How do you get in touch? 5 spots. Here's the phone number, 800-948-1216. That's 800-948-1216. Or you can text NOBLE to 600-700. Made it very easy for you. You can call the number or you can text. So 800-948-1216. Again, we have 5 positions. They will go fast. If you have any questions, if you have not started planning, this is a great opportunity. If you're in the middle of something and you need a second opinion, bingo, here you go. Call this number now, 800-948-1216, or you can text NOBLE to 600-700. That'll get you up close and personal at Prime Capital Investment Advisors. Meet with Jason Noble and his team, talk about your situation. And we get it. There are a lot of people out there that have probably done a nice job amassing a portfolio, but they don't have a plan. Folks, you need to have the roadmap to get you to your golden years. Call this number now, 800-948-1216. That's 800-948-1216. Or again, if you're a texter, text NOBLE to 600-700. That's NOBLE to 600-700. Coming up on the program, do you find yourself daydreaming about retirement? What you'll do and where you'll go? It is a nice dream. But we have to have a plan to get us there. When we come back, we're going to take a look at retirement regrets and how you can avoid them. That's all coming up next on Clear Picture Financial.